Time is 10 a.m. Good morning, everyone, and thank you all for joining. I can see a few more coming into the meeting room. Very cognizant you're not really here to listen to me speak, but just by way of a quick introduction, this is the final day of our Ideas for Your ISA conference. We've got 5 fantastic speakers today covering our Specialist Funds Day. You'll see on the screen with me, I've got Evie Hambro here from BlackRock, which is superb. He'll obviously be covering BlackRock World Mining. Following that, we've got BB Healthcare, ICG Enterprise Trust, Polar Capital Global Financials, and we'll be rounding off the day later this afternoon with Allianz Technology Trust. So a very, very compelling set of speakers, I think, today. And I would encourage anyone on the line to sign up for further sessions within the calendar invite. In terms of housekeeping from my side, as with previous sessions, participant lines will be muted, but please do use the Q&A function in the bottom right-hand corner of the screen. I've got Kyle Caldwell here from Interactive Investor who will be moderating the session, which is great. And I think in a couple of seconds I'll hand over to Evie, but just by way of a quick bit of background on world mining. Obviously, it's one of the sectors with arguably some of the strongest structural tailwinds going at the moment. It's had a very strong start to the year, and I think it's a fair assessment to say that income continues to be a part of the portfolio that the team are very, very confident about and has delivered great returns. I think that's it from me. So without further ado, I'll hand over to Evie to run through the world mining presentation. Thank you all.
Thanks very much, Hugo, and it's a great pleasure to be back here at Kepler's event. And thank you all for dialing in today. So the plan for this presentation is to go through the most recent results of the trust and then to focus a little bit on outlook. So if we go forward onto this first page of the presentation, last year was another excellent year for returns for the BlackRock World Mining Trust. The NAV total return was up just under 21%, with a share price return of about 17.5%. Total dividends for the year came in at 42.5p, which is an increase of about 109% on prior years. And the revenue return was also a brand new record. So an incredibly strong year for the portfolio with regards to earnings and income. And the board has continued to follow the policy that was set out some years ago of distributing substantially all of the income that's generated during the year. Looking at the results over the longer term period, you can see here the performance versus one of our reference indices, which is the MSCI ACWI Metals and Mining sector. And you can see the return for the portfolio versus that. We also put in here the most recent performance numbers through to the end of February, which has generated a very strong start to this new calendar year after the good returns in the last few years. The other point to mention is the trust is now heading towards its 30-year anniversary in December 2023. Since the trust was launched at the IPO back on the 15th of December 1993, the portfolio has obviously been through a number of cycles, as you can see on this slide. But it gives me great pleasure to report that we are now at another new all-time high with regards to total return. One of the key metrics within this is obviously the mix between capital and income. And I'll say a little bit more about this in a second, but it's very clear from this chart that huge impact our focus on income has in terms of compounding the total return available for the trust. Just to remind investors, the goal of the trust is to deliver a superior total return from investing in the sector through the cycle, and that means not just versus the sector alone, but the board also looks at our performance relative to inflation and also relative to the broader equity markets. And you can see in the bottom of this page the total return numbers of about 1400% versus a 500% or so return for the UK market. The dividend track record has continued to build. I will just remind investors that in 2010, we took the policy of trying to enhance the income potential of the portfolio by maximizing returns from all of the tools that we have available within regards to how we're allowed to invest the assets of the trust. And you can see the impact that that has had over the last 10 years. A substantial rise in income generated and obviously distributed. You can see the difference between the red and the yellow bars being the dividends and the income. I think only twice in the history of the trust have we had to pay an uncovered dividend and use reserves just to top things up. But a new record in income in 2021, as you can see from the chart, taking the total income generated since launch to just under £3 a share versus the £1 invested back in 1993. With regards to the mix, and I think this is an important component of not only our focus on income generation, but also diversification. The mining sector has always been and will continue to be cyclical, and we go through periods where companies tend to turn off their dividends. 2016 is a great example, as you can see on the chart on the left-hand side of the page, the huge fall in ordinary dividends that the trust received in that year. But you can also see by diversifying our mix how we were able to smooth that journey. Strong returns coming in from fixed income securities, where we adopt an arbitrage strategy between the cost of debt that companies have to pay and our own cost of capital. Option premium from selling very short dated exposure to high volatility securities in the portfolio that allows us to add an additional component of income. And then more recently, the build out of income from royalty strategies. And this is 2021 was another year of strong growth from that. And I'll come on to say a little bit more about this in a second. But the mixture of this very diversified components of our revenue stream allows us to not only smooth the journey through time, but also hopefully to deliver that superior yield that we are always after. With regards to the mix of assets in the trust, our top 10 holdings here, as at the end of January, our gearing number of about 11%, the mixture between equities and other securities on the pie chart on the bottom left-hand side of the page, and the commodity mix on the right-hand side. You can see that the single biggest bet is to copper producers. Within the diversified sleeve, there was also additional copper exposure, as well as a large exposure to iron ore, and then a mixture to other industrial metals. The level of exposure to gold is down quite a lot from its peak in 2020, when gold was heading towards about 40% of the trust's assets. Obviously, we've seen very strong performance from the rest of the portfolio, and the rest of the portfolio, but the drivers have really been the industrial growth and recovery that we've seen. In terms of outlook for 2022, it's a very strong demand picture, and we'll come on to say a few more words about that. On the supply side, ongoing constraints around capital allocation and an absence of what we describe as shovel-ready projects has meant that the options to grow supply in this strong demand environment remain constrained. The mining sector during the last few years has continued to deliver a very strong capital allocation process, and that the additional transparency and discipline attached to that has contributed to the ongoing restraints with regards to supply growth. And then lastly, obviously, the very strong financial position for most of the companies in the sector today that are carrying way less debt than they have done in the past means that they are, in our view, a less risky investment because of the absence of that gearing within the balance sheet. And that has reduced volatility, especially to the downside. And this obviously, hopefully, will trigger a re-rating in some of the equities that continue to trade, as we'll show later in the presentation, at a discount relative to historic multiples. Within the trust, we do have exposure to a number of unquoted securities, and this is an area that we've been building up through time. Our main royalty investment is through an Australian company that owns assets in Brazil, its royalties on copper and gold production from a number of operations in the northern part of Brazil. We made the investment back in 2014, a $12 million investment. We've had all of our money back in the subsequent 4 years from making that investment, and I'm pleased to say that the development of their next mine, Pedra Branca, is now moving towards full capacity, and 2022 should be the first year where we get royalty payments linked to those higher production numbers, and that's why we believe we'll continue to see ongoing growth in the royalty element of income that the trust receives. Another area to discuss is our exposure to what are known as Perpetual Debentures issued by Vale and the IPO in 1997. These are very low liquidity instruments. They do trade, but only in a very limited capacity. We substantially increased our exposure to these in 2019, and you can see here the performance of the instruments. Since then, we've had around 50% of our purchase cost back in that 2-year period, and obviously the ongoing yield at these current iron ore prices is likely to present a very significant source of income for the trust. And just to remind people, these are perpetual debentures, so they last for as long as resources production is going to happen in that part of the country. So many years ahead of an ongoing income stream for the portfolio. You can see the mix of payments that we've had, or the track record of payments that we've had over the last few years, and obviously the very large increase in payments during the last couple of years as production has increased in the northern part of Brazil as they've opened up new mines, combined with obviously higher iron ore prices. We've also made 2 additional unquoted investments in the last 12 months. First one is into Ivanhoe Electric, which is a company that is exploration and development potential for copper resources in the USA. This investment has been made on the basis that the company is going to continue to have success and potentially develop these projects into producing assets over the next few years. And then the most recent one is a company called Jetty Resources that was only completed recently. This is a technology company that has uncovered a new catalyst for the extraction of copper from legacy ore bodies, and in some cases tailings deposits, where they'll be able to increase the recovery rates through applying this catalyst, and therefore unlocking the potential for growth in production, but using the same capital infrastructure. So very little new money needed to be able to grow production from existing assets. This is gradually being commercialized with one commercial operation up and running, and as the slide here says, 23 projects at various stages of development. If this company is able to prove this technology is commercial at a much larger scale, it obviously could have an impact in terms of the prospects for the business going forward. Coming on to the mining sector itself, just 4 graphs showing you commodity prices, iron ore, copper, gold, and oil. We've obviously seen strong performance for commodity prices during the last few years, a recovery in demand post the outbreak of COVID, having seen the kind of short-term drops, and most notably, obviously, the ones with extreme moves have been oil. I think some investors will remember that oil actually traded negatively for a short period of time at the kind of peak of COVID concerns. An area obviously important for us is copper. Prices have more than doubled from the lows that we saw in 2020 and moved now to levels that are extremely attractive in terms of profitability for producers. Also, just reminding investors the role of commodities when thinking about interest rate cycles and inflation. Commodities do tend to deliver for investors in terms of protecting purchasing power through time, and obviously exposure to different cycles in financial markets. And obviously today's cycles where we are looking at rising interest rates and also increases in inflation, commodities tend to deliver a lot of value during those periods, especially when inflation surprises to the upside, as you can see on the right-hand side of this page. Strong performance from commodities when you get those kind of outcomes in financial markets. So where are we in the cycle? These two slides just show you some history relative to where we are today. It does look as though we're kind of thinking about, if we were to compare this cycle to previous ones, a kind of mid-cycle pause before some stronger returns coming through as the cycle continues. What I will outline later is that this cycle has a lot of characteristics today that make it feel like it will last for substantially longer than previous cycles. You know, the demand outlook looks to be in place now for a couple of decades, and the supply side being so heavily constrained by a number of factors means that the ability for supply to close the gap to demand for most commodities is going to be challenged, and that should be very supportive for commodity prices and therefore earnings for the companies. In terms of shorter term drivers, we've obviously seen a lot of new information coming out of China in 2022. You know, last year, China took measures to control industrial output and also to try and green the economy, especially ahead of the Beijing Winter Olympics. You can see on the top left-hand side of the page the substantial drop in steel production, which was, you know, one of the largest drops that we've seen. Again, this was not to do with demand. This was to do with restraints put in place by the government to restrict production. We are now seeing China go in the opposite direction. We're seeing a reopening of the economy. We're seeing a lot of measures being put in place to support growth with regards to credit starting to expand, social financing availability as well, and significant industrial projects coming through that all look to be supportive for a much better picture with regards to commodities demand in China, which, just to remind everybody, is still the world's largest consumer of commodities. Some of the other measures that China put in place, not only around controlling industrial production, but also focusing on the environment, did have an impact in terms of production rates and consumption rates. One of the more intriguing ones is obviously the shift with regards to electricity. And we are seeing commodities that have a high intensity of energy in their production process, seeing a complete repricing, and none more so than aluminium. And you can see on the right-hand side of the page the move in the aluminium price. You know, as aluminium is pretty much dominated in terms of its production costs by power, with the rising power prices that we are seeing around the world, some of which obviously linked to fossil fuel prices. We are seeing this flow through into the underlying metal prices, and where we have producing assets that don't have that exposure to higher power costs, like ones that are driven by hydro or renewables, we're obviously seeing a substantial margin expansion for those businesses, and we are trying to play that strategy in the portfolio. I mentioned supply side challenges. This is commonplace across the resources sector. Not only are we seeing assets developed today that are substantially more capital intensive, with lower production grades, making it harder to extract the minerals from the ore, but we're also seeing existing assets continue to be challenged in terms of maintaining current production goals. You know, obviously challenges around labor, environment, water access, emissions, and supply chains are all having an impact in terms of current production rates. And when we see production disappoint, it obviously bodes well for commodity pricing. Also on the demand side, we are now in this environment where I don't think the world has any choice but to spend an enormous amount of money to green the global economy. We've seen very, very large fiscal related spending plans coming out of the EU and the US. And this is really a very different picture to the ones we saw in the China-related bull market for commodities in the first part of this century. That was very much driven by a new consumer arriving, seeking to urbanize and industrialize their economy. And you know, the world was completely dependent on Chinese demand to see demand growth for commodities. What we're seeing today is a different picture. You know, we're seeing one one where the demand growth is more spread out around the world. The developed economies are having a much bigger impact in terms of commodity consumption, and this is playing out in creating markets that are tighter than we've seen, based on pretty much all the historical data that we look at. So should these plans come into place, which look ever more likely today following the conflict in Ukraine, with accelerated plans to increase energy security, in addition to the greening of the electricity markets, we will see this growth come through faster than expected. Faster than expected in a market that is already tight and supply constrained. That it could lead to some very volatile commodity pricing. In terms of the longer term drivers, I think it's worth reminding investors of a couple of factors. The first one is on supply discipline and capital allocation. You'll see the peak in capital spending back in 2012 at the end of the last cycle, and obviously the very strong or large falls in capital spending over the next kind of 4 or 5 years. We're still well below the levels that we were at in the previous market, and most of the growth in spending that you can see here is related to sustaining capex, but also the greening of resource production. Many companies are now aggressively onboarding their own organic decarbonization plans to try and reduce the carbon footprint of their operations on a scope 1 and scope 2 basis. And this is obviously competing for capital within regards to where companies are allocating. So a choice between growth in production versus decarbonization, it tends to be the latter that is winning at the moment, with large amounts of money being invested in moving away from diesel-powered trucks to electricity, or even hydrogen-powered trucks, renewable power supply to existing assets away from fossil fuel-related ones, and so on. Even in South America now, we're seeing big plans around desalination plants for water needs for resource assets, which again is increasing the capital intensity per unit of production, making it harder to justify investment in new supply, given the higher capital burden, without seeing better prices to get the returns that are needed. The other area for competition of capital continues to be money coming back to shareholders, and it is fantastic to see that companies are continuing to reward investors with very substantial dividend payments, which obviously is flowing through into the trust's ability to be able to pass that back to our shareholders. One area, though, that has increased sharply has been share repurchases. We could have done an entire slide on this. We've given the number of share buyback plans across the resources space. One thing to remember about resource companies is that they are mining the assets today, and if they're not investing for new supply, then through time production will decline. But if you are decreasing the number of shares in issue, then you're actually growing the amount of production on a per share basis. And so by reducing the share count, you actually deliver production growth to each share, and growth in value to each share, depending upon the prices that they're repurchased for. Given the rising capital intensity for new projects and the scarcity of ability to invest in new projects, probably the most efficient way for these businesses, given the multiples they're trading at right now, is to reduce their share count and therefore grow value on a per share basis. So we do feel we will see a greater amount of buybacks going forward than we have done in the last few years. In terms of the carbon transition itself, there are a number of drivers here. We focused in on copper. You can see the likely growth in demand from solar, from wind, from electric vehicles, and so on over the next few years. Obviously, this line is every time it's reviewed, it tends to get steeper and steeper, and especially since obviously the moves in the last couple of weeks announced by the EU to rapidly de-risk the supply chain for energy away from dependence on the imports of Russian fossil fuels. This is likely to grow that demand even faster in the short term, as this area really rapidly ramps up in terms of construction activity. But it's not just these applications for copper. You can do this for nickel, for lithium, for cobalt. You can do it for steel. It's across the mix of metals that are needed during this period of the transition. And given we're talking about trillions trillions of dollars of investment required over the next 20 years or so. This is very much a long-term trend that's going to be supportive to the commodity markets. To put this into context, this slide really just highlights the differences in resource intensity per unit of power. On the left-hand side of the page, you'll see the commodity intensity for a 100 megawatt natural gas-fired turbine. And on the right-hand side of the page, you'll see the metrics for wind turbines required to generate the similar amount of energy. Just comparing these on a like-for-like basis, 300 tons of iron ore versus 30,000 tons of iron ore, 2,000 tons of concrete versus 50,000 tons of concrete, and so on. It is very much more commodity intensive to have a greener supply chain of energy, and this obviously bodes very well for commodities demand growth. With regards to the companies, one thing that is in stark contrast today versus the past is how much more robust balance sheets are. You can see on the right-hand side of the page that the mining sector today has the lowest level of gearing of any equity sector that we look at. This is in complete and utter contrast to the past, and it's an intriguing factor that we think about when investing in the capital right now. For most of my investment career, I've been used to mining companies having levels of 30% gearing, and today seeing companies often with close to zero or even net cash on their balance sheets. This obviously has a dramatic impact in terms of the risk that people think about when investing in these companies. If you don't have that level of gearing, then the risk, the downside is reduced when commodity prices deteriorate. But if commodity prices stay strong, the ability for the company to be able to return cash to shareholders because they don't have to service debt, the ability to pass that back rises rapidly. Hence the very high dividend yields that the companies are on right now. With regards to valuation metrics, and we've chosen this one, EV/EBITDA, but you could do PE multiples, free cash flow yields, dividend yields, etc. The sector is trading well below where it has done for most of its kind of investment life. This goes back 30 years, this slide, and you can see today's multiples being very much at the bottom end of the range, despite the fact that the companies today have much stronger balance sheets and therefore have a lower risk profile and a better capital allocation process, which means that there's a higher probability of returns coming back to shareholders. And you've obviously got a very strong demand outlook and a constrained supply picture. It is confusing to us to see such low multiples given the picture that we see for the sector as a whole. So it's a very exciting or enticing investment environment for us when thinking about this space. It would be remiss of me not to touch on ESG, and we've set out here over the next couple of slides just the main bullet points with regards to how we think about ESG in the context of the mining sector. It is a bit of a challenging one for investors to kind of get their mind around. On the one side of the equation, you have a historical track record of ESG for the sector, which is far from good. And on the other side, you have this very strong demand picture driven by ESG, the carbon transition, the greening of the global economy, which is making it an incredibly exciting investment outlook for the businesses. So major beneficiaries on one side, but a track record that's not great on the other. How do we navigate through those two things is the kind of key question here. Well, the first is obviously to try and focus on companies that are operating in the right way. And at BlackRock, we have an ESG investment process that is integrated across our active platforms, where we focus on all of the different factors to make investment decisions. And I think it's an integral way to us thinking about how we invest in companies. One key important point, though, to remind investors about is sometimes companies do have a bad outcome, but through our investment process, if we are able to uncover a substantial change, a robust new approach to operating that we build confidence in through time, we might back companies that have these clear and evidence-based approach to change that will hopefully take a company from being penalized in terms of its investment multiples, whilst people think about it as a bad player in this regard, to an improving picture where those multiples and discounts, multiples will expand and discounts will reduce. And if we can back a company that is making a positive impact as a result of these changes, then that's great not only for the environment and for the economy, but also good for our portfolio. So I think having this ability to be able to be flexible and use a kind of an integrated active approach to ESG rather than being beholden to third-party data providers to tell us what to do should be able to give us an edge with regards to generating alpha in the portfolio. So just the final slide in terms of summary before we go to questions. I can see a couple coming through whilst I've been speaking. I think the first point, just to remind people, is that we have a very strong demand outlook for commodities, driven by obviously the recovery in demand from the lows of COVID through to this very, very exciting decarbonisation plan for the global economy, which is going to drive demand growth for many years ahead, as we see those kind of trillions of dollars being invested into green related investments in infrastructure and operating and decarbonisation of asset bases of companies and in society as well in terms of our own lives. On the supply side, we've been through a long period of underinvestment into supply. This has meant that the sector, despite high commodity prices today, doesn't have that price elasticity of supply to be able to just rapidly increase production. There is an absence of shovel-ready projects that capital can be committed to. So we do have this window ahead where supply response is likely to be muted, and therefore demand is going to be the dominant factor when it comes to setting prices. The sector today has incredibly strong financial metrics, being the multiples that it trades on, and also the very robust balance sheets that we see, and obviously poised for to be able to deliver the kind of historical relationships when we do get inflation surprises and rising rates. And then lastly, with regards to the trust, obviously our goal continues to be to deliver that superior return through the cycle from investing in the sector. And I hope that investors are pleased with the record levels of dividends that we've been able to pay in 2021. So thank you for that, and I'll hand over to Carl with regards to questions.
Great, thank you very much, Evie. Hi everyone, I'm Kyle Corbell. I'm the collectives editor at Interact Investor, and I'll be moderating the Q&A. So if you'd like to ask a question, please put it in the Q&A box, and I'll try my best to get to it in the 15 minutes that we have for the Q&A. I'm going to start off with a couple of questions that I think will be particularly relevant for retail investors. And the first one is, are we at the start of a new commodity super cycle? And is this potential new commodity super cycle being driven by the global green revolution as major economies strive to decarbonize?
Yeah, I mean, I think we've touched on this a bit in the presentation, but I'd say absolutely. We've got a number of factors here. Starting with the portfolio itself, we are seeing companies outline plans to decarbonize their own operations. We are seeing very, very clear pathways between now, 2030 and beyond to reduce the carbon footprint, water usage, etc. for existing resource assets. So we will be moving into an environment where we believe commodity prices will not only be linked to the quality of the commodity in terms of its purity and so on of the final product, but also how that commodity was produced. And we think that will play out in pricing. So we're likely to see carbon-related pricing come into commodity markets and other metrics with regards to the kind of ESG credibility attached to the production of the resources. And this is likely to create a differentiated market where you see kind of green pricing for copper, as an example, versus non-green pricing. And the non-green pricing is likely to trade at a discount to the greener production processes. So this is, I think, a really exciting dynamic, which is likely to accelerate the transition to greener production processes. I think that the second element obviously is in broader demand for commodities, as we touched on. You know, it is substantially more commodity intensive to have a green global economy than the traditional fossil fuel one that we've been used to for, you know, well over 100 years. And this move is likely to happen over a very short period of time. You know, we've been in a fossil fuel based economy for a couple of 100 years now, and we're going to be moving to a green one in probably, hopefully, only a decade or two. And if that transition happens at the speed that it is anticipated to, then we will see this enormous amount of commodities demand come through in a very short period of time, with a commodity producing sector that's just simply unable to respond at the speed that's needed, and that'll play out in pricing, and which will be obviously good for producing assets. So, you know, it's going to be a key driver of returns going forward, both as companies decarbonize themselves, but also as they look to benefit from the strong demand picture.
You ran through a couple of points on China in the presentation, but I wanted to more specifically ask, how much of a concern for commodities is the slowdown in China's property sector?
Yeah, I think we've obviously seen lots of cycles within China itself. I remember investing, you know, at the start of the previous cycle, where, you know, every year there would be the doomsayer saying that the China situation can't continue and China's economy is going to fold over. And every year the Chinese economy exceeded expectations, and I think pretty much has continued to do so, despite it not going up in a straight line like nothing always does. There are always going to be pauses with regards to growth in any part of the global economy, and China's no exception to this. As I outlined in the presentation, we've seen a number of measures last year, environmental driven, but also other measures to kind of cool growth. And, you know, these are now being reduced as China looks to accelerate again. You've seen a lot of rhetoric out of the government in the last couple of weeks, highlighting how their ambitions around new growth levels, 5.5% GDP growth, and measures being put in place to support that growth through expanded financing, and, you know, and relaxation of controls with regards to construction activity, especially in moving in the residential sector. So I think, you know, you'll always see these measures come, yeah, and they'll be turned on and off, but the general trend is very much supportive. But one of the other key factors I tried to get across in this presentation was that what we're seeing today in the market is less dependence on China for commodities demand growth. You know, China is still the biggest consumer, and it is therefore important that demand is continuing to grow, but the very substantial increases in consumption in the developed economies are a key difference to this cycle versus the prior one. And I remember when I started doing this job in the 1990s, what we were always looking for is synchronized global growth to create a proper bull market for commodities, and we're seeing all of the signs of that today.
So you ran through the trust approach to ESG in the presentation, but again, I was hoping you could more specifically run through how mining companies are improving their ESG credentials, and when weighing up a potential new investment, what sort of things are you looking for to sort of tick the ESG boxes?
Yeah, so obviously we have a lot of tools at our disposal at BlackRock, given the scale of the business and everything that we subscribe to with regards to third-party data providers. But we also try to do our own work as well. I think many of our shareholders will be familiar with the fact that the team, you know, when we're allowed to and not restrained by COVID, seeks to travel and see resource assets around the world. It's a big part of our investment process. You know, I remember my first trip as an employee in the former firm of Mercury Asset Management was to a gold mine in West Africa in 1996, and part of that process was to see the asset, see what was going on the ground, but also to look at the ESG characteristics of that asset, to engage with the local communities, meet the local regulators, to work out what the impact of that production is going to be on the communities, employment, infrastructure, etc., and any ancillary benefits from capital that was being invested in that asset. You know, that was an important part for us of the risk profile. You know, if that company and the development of that asset was supported locally, then that would be an important part of that asset's value creation. If the communities were against it, it would obviously make life much more challenging for the company that was seeking to operate it, and therefore you could have a clear impression of the risk profile attached to that. So ESG has always been, a risk factor, and focusing in on it has hopefully been able to allow us to avoid many of the challenges that we've seen at some assets. Now, I also said in the presentation that from time to time we will back companies that are recovering from ESG issues, where there is a big value discount that's played out in the market, and where we think we have an edge in seeing improvements coming through. And we've certainly done that. We've also taken measures to exclude companies from the portfolio where ESG track records are neither improving or declining. And we've definitely taken measures to do that in the past as well. So it is an important part of our process that allows us hopefully to manage risk through a specific lens.
And following on from that, a question from the audience is, have you exited any companies because of ESG issues?
Absolutely, we have, but it would be unfair of me to go into specific measures in that. In our annual results that we released, we did talk about some specific investments where we have reduced exposure and exited entirely, but it would be unfair of me to go into specific details on companies.
And I'm going to move on to gold. We've had a question which asks you to give your outlook for the yellow metal.
Yeah, we're always asked about this, and gold is something that's always been intriguing to me as a person, but also as an investment. And the gold market today is in our view quite exciting, and so when we look at the gold market, trading just under $2,000 an ounce, the previous high reached a couple of years ago. All of the inflation characteristics that we see in the market, and I think, as everybody knows, gold has been one of the best ways to protect purchasing power through time for thousands of years, and I don't think that is any different today. So for us as an investor, that's a pretty attractive outlook. Having said all of that, when we look at the valuation characteristics of the gold companies today versus the broader industrial mining companies, the huge discount that the broader mining companies are trading at relative to gold companies makes them a more exciting investment for us in the portfolio, and hence the allocation we have today of around 15% or so to gold producers versus the industrial complex making up the balance of the portfolio. So it's really an investment metrics decision rather than necessarily a commodity outlook. Could gold perform very strongly from here? Absolutely. But given we're able to buy the broader mining companies on, many times more attractive multiples, gold companies on kind of 5 to 10% free cash flow yields, and some of the broader mining companies on 20+% free cash flow yields and double-digit dividend yields with zero debt on their balance sheets versus gold companies that are still carrying debt. The investment metrics obviously point in favor of the other part of the portfolio right now. But we do move that around, and I would expect us to continue to do that in the future.
That was going to be my next question. With the gold mining companies being so cheap relative to the bullion prices, do you intend to increase exposure?
Yeah, as I said, we obviously look at all commodities producers relative to the investment metrics that they're trading on, and as I said, the huge discount that the broader industrial metals companies are trading at relative to their own past, but also relative to the precious metals. To us, it means that we've got more capital allocated there than we do to the precious metal side today.
You mentioned unquoted companies in the presentation. What is the allocation to unquoted, and what is the maximum amount of exposure that can be held?
Sorry, could you repeat that again, Carl? There was a bit of interference.
Okay, sorry. You mentioned in the presentation unquoted investments.
Yes.
What is the current allocation to unquoted, and is there a maximum percentage that you can invest in?
Yes, so there's probably a number of ways of answering that question. So yes, there are metrics that we work with. The main unquoted investment today we have is our royalty position through the Australian company Oz Minerals, as we touched on in the presentation. That's a couple of % of the assets of the portfolio right now. The Vale debentures, which are actually quoted, but we put them into the unquoted area because of the limited liquidity, are about 3%, and then we have about 1% each in the other two private companies that we're invested in. We are trying trying to ensure that any of the private companies that we invest in, we don't hold those companies for too long in the private space, and so that they have very clear plans to be able to create a liquidity event in the future. And we would hope that that is an area that is a kind of an area of turnover for us. So by investing in companies prior to them coming to the public markets, the duration of the position is relatively short, but the discount that we try to buy these businesses at relative to their likely pricing when they come to market is substantial. So we get the return for the slightly higher risk and for the lack of liquidity. So it's an area that we would seek to have kind of relatively rapid turnover within.
The next question asks, given the low levels of investments in capacity in recent years and relatively high commodity prices, how confident are you that companies will maintain capital discipline?
It's a great question, and it's something that we're extremely focused on. You know, one of the single biggest risk factors is that, as we like to say, you know, leopards don't change their spots. The resources sector has always been cyclical. We've always seen a kind of boom-bust approach to investment by companies, where they, you know, get far too excited about the future when commodity prices are high and make some irrational, value-destructive investment decisions, and then just when things are at the low and they get too depressed and stop investing, and you get this kind of boom-bust cycle that develops. We have seen put in place some very, very transparent capital allocation processes by most companies, and for them to diverge away from that would be a warning signal for us. We haven't seen that. Olivia and I have just returned from a resources conference in North America, and we obviously engaged with a huge number of companies over a 3-day period, and in not one meeting did we find a company that was looking to move away from their capital allocation process or to ramp up investment into new supply beyond anything that was considered for us to be very reasonable and rational. So right now we have very, very high confidence that we will see a continuation of the more disciplined approach to capital allocation, which means ongoing high levels of payments back to shareholders and therefore hopefully continuing to benefit the trust.
We're just going to ask one more question, and that is, do you have any views on uranium, graphite and rare earths? Do they feature in the portfolio at all?
Yes, a great question. This is obviously a really exciting area. These commodities don't play a huge role in the trust or in the global economy in terms of their kind of being large in terms of liquidity and so on, but they are absolutely integral to the energy transition. It's likely that we're going to see nuclear power have a role during the kind of just transition period that people are focused on, especially as baseload power for a number of economies around the world. With regards to some of the other kind of more minor metals, they are absolutely integral to many of the technologies that the world is looking to deploy to decarbonize itself. Rare earths are going into everything from mobile phones to electric vehicles, and without those commodities, it's just not going to be possible to be able to make the changes that are needed. Lithium, likewise, lithium is going into every single battery, and as the world seeks to run more on an electric future than we have done in the past, batteries are going to be essential for that part of the transition. So the growth we're seeing in lithium demand, the better pricing, the economics that are attached to the assets means that we have exposure to both rare earths and to lithium producers in the trust, and it's been a core part of some of the performance that we've been able to deliver over the last few years. Uranium is not a big part of the portfolio today. We think there are a number of characteristics on the supply and demand side there that are less attractive than the opportunities we see in the rest of the commodity mix.
Thank you, Evie. So that concludes the Q&A. I'm now going to hand back to Hugo.
Good stuff. Thank you, Kyle, and very importantly, thank you, Evie, for that presentation. Very, very compelling and a great way to kick off the final day of the event. I think we'll call it a day there. Look forward to seeing hopefully a number of you on future sessions throughout the day. To those that won't be joining any further sessions, have a great day. And again, thank you to Evie from BlackRock for that kickoff presentation.
Thanks a lot.
Brilliant. Thanks all. Bye-bye.